What's up, guys? Welcome to another episode of Invest Iowa. Today we have Kurt Moore. Thanks for coming, man.
Thanks for having me.
Captain Kurt.
You got it.
So,
today we are going to be talking about the loan market in the residential world. So we're going to talk about Kurt and his past, how he got to where he's at now, the different places he's worked, and why he's moved around a little bit, why he's at where he's at now, and then the different loan products that there are out there, and why certain ones are advantageous for different individuals. Like when to use this kind of loan and when to use a different kind of loan, and just all those different products, and why it's important to know that there's more than just an FHA or conventional 30-year loan out there. So let's first start off with like talking about yourself, where you grew up at, and how you got to where you're at now.
Yeah. So grew up in Boone, Iowa, so just about 40 minutes from here. I am currently with Lincoln Savings Bank as a lender, mortgage lender, residential. Prior to that, I was with a company called Flagstar, and then prior to that was Wells Fargo. So collectively, a little over 10 years in mortgage lending. And yeah, it's funny. I'm in mortgage lending now, but I actually have a degree in culinary arts. So how that works is everyone goes to college for something, and maybe 1 out of 5 end up doing something in that line of work. But yeah, real passion is kind of in food. But
really,
ended up in mortgage. Yep.
So yeah, that's interesting. Let's go down that path. How did you start out in food, then end up at Wells Fargo?
Yeah. So in the food industry, went to college, made a couple of good gigs that I thought, hey, I made it, right? I was 19, 20, and you kind of realize in the food industry, once you get higher up the chain, you do get into a salary, but you're still working those crazy hours, right? Mm-hmm. So by the end of the day, it's like, you're 20, you're making 70, 80,000 a year, you think you made it, but you're opening, you're closing, you're working all the holidays, right? And when you factor in the hours you're working, it's like, you might as well be a line cook. Yeah. And you don't get many holidays off, so not a lot of time with family. And just ended up getting into sales, and the role I'm in now, it gives me so much flexibility, right? Freedom to, if I want to take a Friday off, I take it off, right? If I'm going on vacation, I'm not putting in a PTO request. It's if you're not working, you're not getting paid type of situation. Mm-hmm. So it's provided some real flexibility and really improved kind of just overall living, right?
Yeah.
In that line of work.
So did you work as a chef, like opening and closing your own spot, or what?
No, yeah. So landed at a Hilton in Cedar Rapids. I was there for a while I was going to school, and then a couple of different restaurants where just kind of running as like a sous chef, which is next in line to executive, and you just get into that role where now you're handling banquets, right? And you have to help open and train, and you've got to help close because, all the big dinners happen at night, and you got to be there to kind of oversee that stuff. So it just turned out to where you were working a lot for little pay, and you start to realize that, kind of the older you get, you're like, this cost of living is kind of climbing, right? So it didn't go very far.
Quality of life was low. And I see that you're married. Kids?
Yeah, I've got 3 boys. Yep.
Oh, awesome.
Yep.
That's cool. What ages?
I've got a 3-year-old, a 7-month-old, and I've got a 12-year-old.
Wow.
So how do you transition now from, Hy-Vee? What was it, Hy-Vee?
What's that?
Hilton.
Yeah.
Hilton. How do you transition from the food industry to now banking? What does that look like?
Yeah, so when we moved back to Des Moines, I had landed at a restaurant and just ended up just not being very happy, right? And kind of reaching out to my circle of influence, right? Friends and family, just trying to figure out where should I go. And the kind of deciding factor was, hey, you need to be in sales. And I actually met a guy who said, hey, you should apply to try and do mortgages at Wells Fargo. They're kind of the starting point of entry level. They do a really good job of onboarding and training and stuff like that. And you do a ton of loans. I mean, I was doing 20, 30 fundings a month, right? Mm-hmm. So you got to see a lot of stuff. So I applied for Wells Fargo, and they wanted me to have some phone experience. And so they threw me in the call center, which lasted for about 6 months. And I ended up getting into loan processing, which is on the mortgage side. They're the ones that collect all your documents. And then I figured out how much the mortgage lenders were making, and I was like, man, I gotta get over there, right? And about 4 or 5 months later, I was landing as a loan officer. And so, yeah, Wells Fargo, say what you will about them, but they do a really great job about kind of helping you understand different products, and you really get to see it all. So that was really nice. And after that, after about 6.5 years, I think most of us were just kind of realizing there were other opportunities out there to make better income. But it is switching from taking calls all day to, going out there and kind of chasing business,
right.
just like a realtor would or anybody else. You kind of transition to 100% commission, which is where I'm at now. So it's a constant hustle. You got to be out there and meeting people, right, and staying busy.
That's cool. So you touched on something there that's really important for investors, business owners as you're building a company. You said Wells Fargo does a really good job of educating you on their products, right?
Yeah.
So, and I've also heard they do a really good job of like training individuals, like onboarding. What do they do that separates them from everybody else?
Yeah, so when you start on with Wells Fargo, there's going to be 2 to 4 weeks where they are dedicating subject matter experts, right? So it'll be loan officers that are really good at what they do, and you're sitting in a classroom just running different scenarios and taking mock phone calls and all this stuff. And then finally, after you pass all of your tests, they kind of throw you in. There's this day where everyone puts their headset on, and it's like, you got to go inbound, which means you're going to take a phone call from your first customer, and you just kind of wing it, right? You're sink or swim, and you might be lucky enough to have a SME sitting next to you to kind of listen in and help you answer questions, but a lot of it is really just blowing smoke, right?
Mm-hmm.
You hope that you know all the answers, but at the end of the day, it's important to remember that the majority of the consumers that are calling in with mortgage questions, they know less than you do,
mm-hmm.
right? You've been training for it for a month, right?
Yeah.
So even if you don't have all the answers, or maybe it's not absolutely correct, you are the quote unquote expert at that time. So yeah, it was a thrilling time and a lot of good opportunity there and awesome benefits. And I think it's just a matter of looking for something else, right?
Yeah.
Is can you handle supporting your own business, right? There's no 9 to 5. There's nothing of that. You wake up each day and you got to decide, what am I going to do today?
Kill what you eat.
Yeah, exactly. What am I going to do today?
How do you treat your business as a loan officer?
How do I do business now?
Mm-hmm.
Yeah, so it's really my biggest focus is realtors, right? You need to have good relationships with realtors that are going to trust you with their commission. They're sending people your way, and you've got potentially tens of thousands of dollars in commission that you're responsible for, that realtor is trusting you with, right? So it's a matter of getting out there, tons of coffees, right? I drink more coffee in a week than anybody probably should. Lunches, going to the realtor events, DMAR and the Iowa Association of Realtors. You've got to be seen. You want everybody in the area to know who you are as a lender, and for the right reasons, right? So, whoever's got the more friends is going to be most successful, really, in this kind of business.
What do you do at those events and coffees and all that stuff to separate yourself from? Because obviously you're not the only lender out there trying to get their business.
Yeah.
So what do you do to separate yourself?
Yeah. So I think what I've stopped doing is when you sit down with a realtor or a potential referral partner, the mistake a lot of people will do is they'll bring a bunch of flyers and pamphlets and booklets and, hey, here's what I can do and here's why I'm the best, our rates are the best, or this. And I've kind of stopped doing that, and it's really just truly sitting down and having coffee and trying to get know somebody and see if it's a good fit. Because there are different personalities out there, right? If you guys clash, you're probably not going to get along, right? If you're somebody who wants updates every day, but you're working with a loan officer that operates at a capacity that they do their updates on Fridays only, well, then you're probably not going to get along. And so I think that if you like somebody, it's probably going to be easier to work with that person. And so that's kind of what I've just been focused on, is I'm usually not bringing work into it unless they're asking questions, and just trying to, get to know that person and understand what they need and where they came from.
And how many different realtors do you work with now?
Oh, that's a good question. So I've probably got 10 to 15 good realtors that I really like working with that send me the majority of my business. But obviously I'm meeting with 5 to 10 realtors a week, right? So it's just a matter of whether or not they stick. looking to get a little bit bigger this year and probably hire on a junior who can help me take the applications while I'm out networking and doing all that stuff, attending closings.
That's cool.
Yeah. Yeah.
And how are you? So, like, besides the events, how are you finding these 5 to 10 introductions a week that you're trying to sit down with?
Social media. A lot of it's social media. Everyone's got coaches, right? The realtors have coaches. We have coaches.
Do you have a coach?
I do, yeah. The general tune that you will be coached as a loan officer is, print off a list of realtors in your area and cold call, right? You should be calling 15 people a day, but I don't like receiving cold calls, so I don't do it either. Mm-hmm. I don't cold call people. Usually it's trying to get out there on social media as much as possible, and eventually you're going to run into a realtor who interacts with your social media enough, and you just reach out and say, hey, it looks like we enjoy a lot of the same stuff. Let's grab coffee or whatever. And then it's kind of like a warm introduction, right? Like you feel like you already know each other because they've been following you online and that, they like what you do. So that's been my big platform. And I think everyone's pitching that this year, right? Social media, you got to be out there, long form, short form, creating content, providing value. And I think it's absolutely true.
Matter of fact, that's how I found you.
Yeah, exactly. Yeah.
How do you now? Before we actually started recording, we were talking about interest rates, only payments, and all that type of stuff. How can we get started in that conversation? Because I thought it was very interesting that you were mentioning, Daniel, that not everybody should be interested in just having a fixed amount with this 7% interest now that we're living on.
Yeah. So interest rates are a big topic, right? And they have been for since June, July, and there was a lot of positivity, right? Rates were getting pretty low there for a little while, and then the last week.
Let's stop there for a second. What was the lowest that you've done in the last 2 years? What's the lowest that you've done a mortgage at?
In the last 2 years?
Yeah.
Yeah, 15-year, I saw a couple of 2.5% out there, nice. Right? It was
lowest 30-year.
Probably 2.875 would be that.
That's super low.
And that becomes pretty intense, right? I don't believe that that'll ever happen again. And a lot of economists and others will suggest that rates being as low as they were for that long is likely the cause of some of the stuff we're seeing right now, right? It's called a refi boom for a reason, because they're supposed to be kind of short last, and they're not supposed to last 3 to 4 years, and they did, right? Rates were super low. When I started initially, the average 30-year was, sitting around 5.5.
Oh, really?
0.875.
When was that?
That would have been that was 10 years ago, right? So
10 years ago was 5.75.
Yeah. So and so that was when people were still pretty happy, right? You quoted them a 5.5%. They were pretty pumped to be into something like that. But no, the pendulum's kind of swung, and interest rates are climbing back up, and a lot of economists and everyone else are suggesting, hey, they're going to hit 7%, 8% before they come back down again. And who knows, right? I think that's why a lot of people will say time in the market is better than trying to time the market, right? It's like trying to catch a falling knife off the counter. You let it fall, right? Trying to time the market and get that perfect rate is going to probably cost you in the long run. You're better off just get into the market if the time is right for you, and if they do come down, great. You refinance at some point and you save some money. But I know there are a lot of people on the sidelines that were probably hoping the rates were going to get even lower, and now they're right back up to kind of where they were, right?
Yeah, I think that's an interesting point, right? Because it's like so many people are so fearful right now because of the rates. And what you said is so true, because it's like, and you got to think, anytime you're trying to grow wealth, you've got to think, I mean, obviously there's different types of methods to grow wealth, but you're like, is it short-term or long-term, right?
Yeah.
And if you're looking to get rich off of a short-term, buying a single-family home, I would say that's probably, like, unless it's a fix and flip, the interest rates don't matter. Like if it's a fix and flip and you're doing a 30-year, I mean, usually you buy that cash anyways. But then if not, then you're looking at it long-term and you're like, this is a 30-year thing. Why am I going to freak out over interest rates being at 7% for maybe 24 months when the term of the loan is whatever, is 360, whatever it is? It's like, why be so fearful of this when you could get in this for 2 years and then it could go back down to 5 and you lower your basis,
Yeah. And a lot of people don't understand is the first 10 years of your loan anyways are really going to be majority interest. Right. And so I think when people get fixated on the rates, that's really a matter of affordability, right? They're going, oh man, last year I could afford a $300,000 house because of where the rates were, where now I can only afford $250,000. And it's like, well, if it's your first home, get into something that fits, right? And it's not going to be your dream home, right? My wife and I, we're in the middle of selling our house right now, and we were there for 5 years, and we'll walk away with, $80,000. And we put 3.5% down, right? So I invested less than $8,000. We needed a roof over our head. Now we're selling and moving to a new place, and we are pocketing $80,000 from that, where you wouldn't have renting, right? And I know that's kind of an overplayed quote is, rent's 100% interest, right? But it really is. I mean, if you're paying $2,000 a month in rent, you're throwing $24,000 a year just kind of out the window, right? That's kind of my opinion is you need somewhere to live, so why not build equity, right, while you're doing it? Yeah,
I think there's obviously that frame of that school of thought where I kind of fall into is once you're in a certain wealth category, once you've built up enough of a nest egg, then I actually do agree with the school of thought of like you should rent because your money can multiply faster at a 10%. Let's say you're getting 10% of your money every year. That's faster than what your house is appreciating at typically. And so it's like I could invest, I could put $100,000 into a single family home as a down payment or something like that, or I could go put that $100,000 into an investment, which is getting me 10% of my money every year, and that obviously is better, and that could actually pay for then your rent. Yeah. So you're living rent free, and you're going to get the upside of the investment deal. But I agree that like to get started, how I got started was the same thing you're saying is like I built up equity in a house, then sold it, and then just kept rolling that money into different things and multiplying it.
Yeah, I mean we're moving into a rental right now. Yeah. So we are moving from selling our house and we're moving into a rental while we maybe try and look for some land or something like that. But yeah, I'm not going to turn around and dump all of that money back into the new place. Yeah. I'm going to kind of hedge my bets, and I'm probably going to put in the minimum down, and as long as it's affordable, right? The only reason to put more down is if you're trying to get into a specific payment or something like that. But
exactly.
Typically, as far as rates and stuff go, it's not always the highest down payment getting the best rate. It's just not. It's just not how it works. But you guys were mentioning products. I think a lot of people don't understand is most of the smaller towns in the surrounding area are almost 100% eligible for USDA loans, right? 0% down. And like my hometown, Boone, that whole town is eligible for USDA, the entire town. Insane. And in a town where your rental options are so limited to begin with, right? Like in Boone, they've got some older buildings where you're renting an older unit, right? So they're small. Most of them don't allow pets. So in an area where rentals are so limited, it really is affordable to get into a home your own because you don't have to put a down payment, right? And
that's sweet.
When you compare or when you combine USDA with like homebuyer grants through the Iowa Finance Authority and stuff like that, I mean, you can get into a home, especially in Boone, with their average price point.
That's cool.
For very little.
Yeah, that's really cool. Talk more about different products because we had a really good conversation offline about all the different products you can use to buy a home, and I think people are really just thinking like, look, it's FHA, it's conventional, and like that's it, So break down the different products. I mean, even go into FHA and conventional, and then the 10 years interest only. I think all that stuff's really unique that I don't hear a ton about out there, and it's really cool to. Because you made a good point offline, too, of like, I'm a good resource, even if you're not a qualified borrower, just for education. Yeah. And I think that's so true.
Yeah, so, every product has its own benefits, right? A lot of people assume that FHA is only for people who have poor credit or, very little down payment or whatever it is. Most cases, FHA is going to have an advantage on a lower rate. It just always has been that way. But typically, the benefit is offset with slightly higher PMI, private mortgage insurance on that. So, you can get into an FHA loan with pretty good rates, whereas conventional might be 3 to 5% down, and it has lower private mortgage insurance, and it automatically falls off. So there are some different things in there, but we, as Lincoln Savings Bank, we have internal products, which is 100% financing too, without PMI. and that's structured as 80-20, right? We're doing a first loan for 80% and then a second loan for 20%. Those typically come with slightly higher rates, but it allows somebody to get into a property with, again, zero down. I helped somebody buy a condo just downtown for $350, and they brought $560 to closing.
Jeez. 500?
Yeah, $560.
How do you qualify for those?
Each bank will be different. We're not the only bank that offers these internal products like that. But in most cases, if you're talking 700 credit or higher, pretty solid DTI, debt to income ratios. Honestly, I would say our qualifying guidelines for that internal product are probably a little more lenient than most of the others.
So if you're like 37 debt to income ratio, and let's break down debt to income ratio for everybody after this, but so let's say you're 37, 38% debt to income and 700 credit score.
Yeah.
Like no matter what else is on my books, if I hit those two criteria, I'm going to qualify for 100% financing.
Yep. Yeah, really. I mean, there's obviously, when it comes to qualifying guidelines, the book's, a million miles long.
Yeah.
But yeah, I mean, that's pretty straightforward. Primary residence is probably the big thing, right? We can't use that product for investment properties. Yeah. So that's a unique thing, right? But we have different internal products for second homes, right? Where you might be able to do 5% down with a 90 and a 5 second loan, and then you're putting the remaining 5% down. So there are some unique things in there. We can also help with, the log cabins and the Morton style homes, right? You've seen the barn dominiums and shop houses are getting trendy. So we can do a lot of that stuff that maybe not all banks will choose to do, just because it's our money that we're lending.
Yeah. Now with 7%, what is the product that you're seeing the most?
Yeah, honestly, FHA and conventional, they're the two kind of go-to things as far as popular products, right? And I think they always will be, because FHA, they allow that bruised credit, right? So you can help a lot more people that you might be able to go down to 580 or 600 for a credit score, whereas conventional is 620 plus, right? So not all people will fit into conventional, but yeah, you touched on it earlier. Even if you don't think that you qualify right now, a lot of my realtors will push somebody to me so that I can look at their file overall and give them some instructions, right? Because a lot of people will get fixated on one thing. Hey, I want to save 20% down or whatever. After 5 years, they go to apply and they realize their income doesn't work, right? Or their type of income doesn't work, right? So I think it's important that, you apply early and have somebody look at your file as a whole, so that if it doesn't work right now, hopefully if you're with a good lender, they'll tell you what to do to get there, right? Whereas some of the big box stores, they're just going to say, no, sorry, you don't qualify. Well, why don't I qualify? Credit. And that's it, right? Well, what about my credit, right? They're not going to give you instructions or anything like that. So yeah, even if you don't think you qualify, you should still be talking to somebody.
Reach out to Kurt, and he can help you understand how you can qualify. If you don't qualify, he can tell you, hey, here are the next steps in order to qualify.
Yeah, you don't qualify right now. It's kind of like the tip I like to say, and I don't want them to get discouraged, right? Because that's kind of the dream, right? Everyone wants to own a home at some point, right? That's kind of that general consensus. But yeah, some people are just paralyzed by the fear of being told no by a lender.
Right. You said you're gonna rent.
Yeah.
So that's very interesting, because why wouldn't you go and buy a house?
Yeah. So for the longest time, we've been wanting to buy land, but it's a tricky juggle, because if you have to sell your house, you have to make an offer that is subject to sale, meaning my house has to sell before we buy. And when it comes to land in this area, everyone's buying in cash usually, right? So it's hard to compete, especially with a good piece of land that you find that's priced affordably. Those go quick. So now we've sold our home. We're getting that equity out, and so now we'll be in a position where we can make a cash offer and we can pull the trigger, right? And it allows us to be a little more competitive. Because when we buy the land, we're going to build kind of like a Morton style home. And when you're building a custom home like that, it is a 9 to 12 month process, depending on what season you start on. And here in Iowa, right, it's middle of February, and we just got 5 inches of snow dumped on us yesterday. So when you are building in Iowa, even furthermore, it can drag on when you're trying to build a custom.
Yeah. Tell us about a product that you really like in your guys' repertoire of products at Lincoln Savings that you think is not commonly talked about or used that can be a good tool for somebody out there?
Yeah, again, I think our most popular is going to be that internal product, right? Yeah. It's that 80-20, 100% financing. And that is kind of a unique product because the bank is holding that debt on their books, right? And so, you know, we saw it last year where Green State was really popular for that. They did a 90-10. Well, they eventually hit their cap. You know, at some point, somebody up top is looking at this and they're going, holy cow, guys, we are currently holding, you know, whatever it is, right? 20 million on the books in 100% financing, right? And when you have economists and then those other people talking about a possible recession and property values coming down, when you're a lender with all that debt on your books, it kind of gets scary. You're going, man, what if these property values do come down and now we're holding this upside down debt? So I think you might see some of that slow this year. You know, I know for us personally, we haven't adjusted our rates on those products for a while because we're like, well, you know, it's kind of in a spot where they don't want them to be too aggressive because we don't necessarily want to do a ton of that business, right? When you're thinking of 100% financing, if property values drop that next year, you're almost instantly underwater. And we see a lot of that with VA loans because it's 100% financing. You get in a situation where they might not be able to refinance or something in the future. And for VA, that's why, you know, the VA streamline exists where there are no loan to value metrics, or the FHA streamline, same thing with that. It's a government-backed program to make sure people can refinance if they need to, even with those low down payment options.
Right. So from your perspective, how do you explain for a first-time home buyer, like the difference between renting and buying?
Yeah, I mean, I think it's just been a matter of affordability, right? And going through it recently, it really kind of gave me a refresher, right? When you're renting, especially if you're renting a house from a reputable management company, right? You're going to have your first month's deposit, right? For us, it was $2,000. You're going to have your first month's rent, another $2,000, right? You're going to have pet deposits. You're going to have all these things that kind of go into it. We had a credit check. We had to have our employment verified. We gave them bank statements. It felt like an application for a mortgage. And when I was putting it side by side, I'm like, you know, I kind of looked up what the property we're renting for sold for. I'm like, man, another $2,000. We could have bought this property with a FHA loan, right? Or a conventional down payment, right? So I think a lot of people don't understand, like, listen, you're already paying somebody's mortgage. You're paying a mortgage right now. It's just not yours. Right. And helping them kind of understand that, but also just the flexibility, right? Especially if you have pets. Like if you look up the metrics on the number of people that will buy a home specifically to have a backyard for their dogs, right? It's massive. It's well over 60%. So wow. You have people that are younger that are like, yeah, when I look at my next living situation, a lot of it's focused around their pets, right? If you're in an apartment building and every time your dog has to go to the bathroom, you're putting the leash on, taking them down an elevator, crossing the street to go to their little doggy park or whatever, especially during these winter months, that's awful. Like, at some point, like, it's nice to be able to open that sliding door and let them out into a fenced yard, right? And you don't have to go out in the snow. So it's affordability, flexibility, right? You get to paint your walls, hang stuff up, you make it your own. There's no surprise visits where they're coming through to spray your unit for bugs or whatever it is. It's your house, right? Yeah. It's better living is really the biggest thing. So,
well, that's pretty cool.
Yeah. And again, people kind of look at lenders as this big, scary, bad wolf, right? And people love to go to the realtors first because it's fun to look at houses. Right. That's why, you know, one of the realtors' biggest complaints is that, you know, people will come to them and they want to see a house before they get pre-approved or pre-qualified. Yeah, it's fun to look at houses. People love to look at Zillow and scroll and imagine themselves in these expensive houses. But for whatever reason, people are just, again, they're paralyzed at the idea of applying for some reason. And
well, especially with shiny object syndrome, right?
Yeah.
Because they look at $400,000 property, and then you're like, well, you're only qualified for 300. Yeah. And now in their mind, the only thing that is acceptable for them is that 400.
Yep.
And they can't get it. So they keep renting, and that it defaults on them.
Right.
It doesn't benefit them.
Yeah, I think people, they fail to see the benefits or the possibilities of starting at a lower price point, right? It's your first property does not have to be perfect, and it really shouldn't be. Like, if you're going to get into your first house and have kids and get dogs and all that stuff, they are going to tear that place up, right? It's not going to be your dream home, right? You might buy a second and a third house before you land in your dream home. And I think that if people can see that and get with a lender and then get with a realtor and they can see some of these properties, it's a huge benefit. And giving themselves enough time. I see it all the time where a renter will reach out to me and they're like, hey, our lease is up in 2 months. We want to buy before then. And then if they don't find their perfect house in that first 2 weeks of shopping, when they'll only go on the weekends, they kind of give up and they re-sign their lease. No, the average time to probably find a house and close, it takes 30, 45 days to close on the lending side, and it's probably going to take you 2-3 weeks to find that perfect house, right? So you should really be giving yourself maybe 3 to 4 months to really get prepared to pack and do all that stuff. You got to get in there early and start looking at places.
Wow. How can people reach out to you if they have any questions?
Yeah, so for me, I don't have a landline or an office line or anything like that. So you just
social media guy.
Yeah. You reach me at my personal cell. You can find me online. I'll share the tags with you guys. But the best way to reach out is text or call my cell, and I'll get you set up and make sure I connect you with the right realtor that helps you kind of meet your needs, and take it slow and we'll get you guys set up. But yeah, that's a big thing.
That was a lot of information. I appreciate you coming, man.
Yeah, man. Great, appreciate you guys having me. Yeah.
All right, guys. If you find this episodes helpful and you like more of the stuff that we're producing, just hit the like button, subscribe, and I'll see you in the next one.